Hello, welcome everyone. We'll just do a quick sound check. If you can hear me okay, just type yes into the little chat box. Very good. All right, we'll get ourselves underway. Week number one. I would first of all like to thank FP Markets for allowing me to do this 5-week presentation. It is for the benefit of all traders, no matter what your level of understanding of analysis is, and I would like to sincerely welcome you to this presentation. And I do workshops myself. I go to workshops and always adding to my what I think I know about the markets, and so I do welcome you. We need to just go through the disclaimer first. The information contained in this material is intended for general advice only, does not take into account your investment objectives, financial situation, or particular needs. And FP Markets has made every effort to ensure the accuracy of the information at the date of publication. So that's pretty much it. It's a pretty standard disclaimer there. So we'll get ourselves underway. A bit about, for those who don't know me, I notice there's some very good friends in the attendees here, including one of my mentors here. So do you think I'm nervous? No. But a little bit of background about myself. I got involved with the markets in the late 90s. I went on to do the Diploma of Technical Analysis with FINCIA in Brisbane at the time. In 2003, I got certification from the International Federation of Technical Analysts in 2004. So along the way, I've held ADA derivatives accreditation for options and short selling, that type of thing. I spent 7 years broking on various desks at Macquarie, Wilson's, Morgan's and such. Investor First was another one. But 7 years on the desk as a client, facing clients and managing their accounts. Currently, I'm a member of the Australian Professional Technical Analysts Association, APTA. I currently write for Thomson Reuters, which is now Refinitiv. I do some technical analysis work for them. I write the black and white report for First Prudential Markets. You can see that on their website. It's also available free. And I'm a contributor into Trading Edge magazine. I write the Commodities Corner. And most importantly, I derive most of my income out of my trading my own accounts in equities and futures. So I was told this, and I totally agree with it, that if you're going to operate a trading business or set yourself up in the markets, get your workspace set up properly and keep it nice and tidy. If you've got a desk with papers and junk on there, I would really encourage you to clean it up and treat it like a business, have just what you need at your fingertips. And in this business, you need at least one, if not two screens, a calculator and a cup of coffee. But most of all, keep your workspace as tidy as you can without any distractions so you can focus on what you're doing in the marketplace. The purpose of these tutorials is to help you build a strong foundation in the correct application of technical analysis. And I'll be working my way around this thing called Dow theory. And Dow theory is, I'll go into a little bit later as well, but Dow theory is a very, very old methodology used to gauge the markets is the better word, not make any definitive decisions, but gauge the markets. Since this was sort of put into place, that people started writing about the markets, there's been more and more work done around price action and support, resistance and trends and things like that. But the basics of Dow theory refuse to go away, and they are still used today by market technicians. So during this 5-week presentation, I'm going to encourage you to discover your own trading plan, and that trading plan will be different from everyone else. You'll probably already found out that you look at what someone else is doing and it looks easy, but once you sit down and attempt it yourself, it is often goes awry, or you change some of the parameters or something. So we're going to help you build an edge, what we call an edge in the market, which will belong to you, or you're going to discover your own edge, hopefully, along the way. And at the end, we'll go through understanding risk and account management. A lot of people ask what the big secret is to trading. I can tell you it's the bottom line here. It's understanding risk and account management is the secret to trading. When we talk about technical analysis and trading, and what I mean by trading is sitting in front of your screen, making decisions to buy and sell something or hold something. When we talk about technical analysis and trading, I often dispute the idea that they're one and the same things. And I would put it to you that when we look at technical analysis, we're looking at price data, that type of thing, trying to make some analysis around it consistent with past data. How does this look into the past? What happened in the past? That type of thing, always in the past. And often we are tempted to try and project that into the future, which I think is a bit of folly. But we're looking at this price action, support, resistance, trends, all those sorts of things. We build rules around what we see as a repetitive outcome. So we try and build some rules around that. So look, if this happens again, I'm going to do this and this based on similar events in the past. And then we simply go and identify entry and exit conditions, that type of thing. So we call this side of it technical analysis. And tragically, a lot of people believe that the better they get at technical analysis, the better trader they will become. And nothing could be further from the truth, because the two aren't linked together in that way. When we look at trading, trading is essentially keeping your basic records of your trade. It's looking at your risk in the market, your money management, and most importantly, your position size. Is brokerage a factor or not in your day-to-day work? And then around the psychology of profit and loss. And often the psychology of profit is much harder than at times than the psychology of loss, when people see significant profits and they hand them back, thinking that they're going to get more profit, and they'll sit there and watch the position wither away back to either their starting point or a loss. So these things on the right-hand side of your screen have nothing to do with technical analysis per se. They are a subject on their own, and we'll first of all be looking at the technical analysis side, because this helps us build a platform to then move across onto the trading side. So that's our intention over the next 5 weeks. So this week we'll be looking at underlying trend. So building an understanding of what an actual trend is, how to identify a trend, and what I mean by that is we'll be looking at some hard and fast rules that analysts use, so that the key in all of this work that we do over the next 5 weeks, the key is that no matter what I do in my chart, I can be assured that someone in New York or Chicago or London is doing the same thing on their chart, because there are some basic rules around the application of technical analysis, line drawing and price analysis, that type of thing. Week 2, we're going to look at short-term price action. So this week, understanding where the basic trend is, and then we're looking at price action as a way to get into that trend, either long or short. And week 3, we'll look at some indicators and the how they, not so much how they work, but some tips and tricks around those indicators. For example, divergence in Bollinger Bands, when we see prices outside the band and inside the band, that type of thing. And then we're going to look at building a simple trading plan just around a couple of ideas. And then week 5, we'll bring it all together with some money management and a little bit of chat about some trading psychology. So this trend idea is essentially a disciplined approach. So we're going to hopefully build some discipline into our application onto our screens, because I can assure you what you see on Twitter and most chat sites there is leaves a bit to be desired. So we're going to look at how the professionals do it, and go from there. So I'll be using the MT4 platform and the Iris platform. I'm going to do a lot of presentations on slides first, and then as we go along, we'll get onto some charts and have a look. I always ask this question in any presentation I do, and that is, we've got two lines of price action here. One of them is the Russian primary index, what they call the Russian primary index, and the other one is the Chicago Board of Wheat prices. And I often ask, well, which one is which? And I actually don't, I've forgotten now myself, but the point I wanted to make was that when you look at both of these price lines, the same things are happening in both of them, is that the prices are moving up and the prices are moving down, and they're consolidating and they're trending and they're not trending, that type of thing. So what we see across all markets is essentially the same, even in Bitcoin, essentially the same human endeavor at profiting and taking losses in the market itself. And this one of these is Bitcoin, and one of these is the S&P 500. And again, I truly can't remember which one is which on there, but they do the same things. They have very strong moves, they have consolidation periods, and they trend upwards, they trend downwards, and they're essentially driven by human emotion. And this is the bit that we really want to plug into and put some hard and fast parameters around that. So the last one is this one here. One of these is the S&P during 1948, and one is the S&P last year. Because people say it's different these days than what it was then. Well, no, it's not. I did some quick sums on this, and when you look at the ranges from high to low, they're pretty similar. The one on the top is actually the S&P during 1948, a lot more gappy than we see on the bottom, because we have so much more liquidity and methods in the market with algorithms and trading robots and things providing liquidity into the market. This is a far easier market in my mind than what it looks like at the top, with all of the gaps all over the place. So, and we see most of the days open and close on the range of the day. So today we get a little bit more opportunity to take different types of intraday trading, that type of thing. This also again is two charts taken at the same time. You can see the date line across the bottom. Two charts, two very different entities. They do the same thing. They have large ranges, consolidation, and underlying trends behind them, that type of thing. And one is Bitcoin and one is US dollar. As I often say, it's like the Bali handbag salesman, where he says, well, it's the same. And it is the same. The prices move up and prices move down, based around fundamentals, based around technicals, based around human belief about something that may or may not happen in the future. So we'll be looking at this concept of Dow theory, which was really put together in a book written maybe 70 years ago now, almost 80 years ago now, by Robert Ray, and he, with the help of William Hamilton. And they put this concept together that the markets move essentially on, which is still true today, on economic cycles around the industrials and the transports. And both of those two indexes are still to this day used to declare whether there is a bull market or a bear market. It is when the two of them confirm each other. And I can assure you that the transports are trending up and the industrials are trending up at the moment, without any sign of reversal at this stage. So we are clearly in a bull market and nothing has changed. So the Dow theory concept, the concept of trends, underlying trends, we can take that and we can apply that across different instruments inside the equities market, inside the commodities market and the FX market, and gain some insight into how prices are performing. So Dow put forward, and Robert Ray really defined this out, was that when you see a primary bull market is a broad upward movement interrupted by secondary reactions. And the primary bull market can last an average of 2 years. And during this time, stock prices advance because of demand by investors and speculators. That's the reason that prices advance, is because there is more and more buying. And it comes down to, even into your intraday charting, prices advance because there is more and more buying and not enough selling. And I would remind you that they're the only two things that occur in every market in the world. There is only buying and only selling. They're the only two actions that take place. So it's we're looking at, when we see a primary bull market, we're looking at industrials with increasing sales. We're looking at transports, are looking at increasing economic activity, and they advance on those two scenarios. So in a primary bear market, which is essentially a broad downward movement interrupted by secondary reactions, and we're going to go into a lot of detail about this secondary reaction. It's caused by economic ills and does not terminate until the stock prices have thoroughly discounted the worst that is apt to occur. I would point out that this observation happens on essentially also on a daily basis around news, that type of thing. As news is taken into the market, news is discounted and market moves on. So a primary bear market is where the industrials see decreasing sales, the transport sees slowing economic activity, is the premise for the underlying markets on a global basis. So this secondary reaction, when we talk about a secondary reaction in the market, we see prices go up and we see prices go down, but it is the secondary reaction that is probably the most important part of our observation. So a secondary reaction is considered to be an important decline in a bull market or an advance in a bear market, usually lasting 3 weeks to many months, which is essentially what we describe as consolidation periods. So during which the price movement generally retraces 33 to 66% of the primary price change since the termination of the last preceding secondary reaction. Now, what that, let's nail this, get this hit on the head first thing. This has nothing to do with Fibonacci. This is an observation of trends basically over 100 years, that when we see significant, what we call a significant primary advance, we often see retracements of anywhere between 33 and 66% on average. And essentially, as you know, it can be shallower than 33% or it can be deeper than 66%. But as a bell curve, as a bell curve observation, most retracements land within these two ranges. So this is the most important concept of when we're looking at risk in the market. As prices advance and start to reverse, often traders will stare at it, say, well, look, oh yes, well, it's come down today, and oh, well, it's down again today, without any concept that this could actually retrace 33 to 66% of its previous advance. And then we get in 6 months' time or 12 months' time, we look back and say, oh, well, there it was. We really want to come to terms with that. So what that looks like in a market sense is that as the market, I'll get my pen out now, as the market advances, we see these retracements in here. These retracements have their own trending action, and we look at around 5% of price movement as being somewhat important. But this entire retracement, if you like, this secondary, what we call a secondary market, can retrace 33 to 66% of this upward move in here, and so on. So as the market advances again in primary markets, we can get pullbacks of 10% in price, that type of thing. And then in the future, we can see this retrace back down into around about 33 to 66% of what we call the termination of the last secondary market, which was down here. So essentially this advancement up here can retrace down here 33 to 66% of that advancement. So for example, if this advancement here, I'll keep the numbers nice and round, if this advancement was $1, this retracement can be essentially 33 to 66 cents. Now, that's fine. When you add in leverage, that type of thing, this becomes critical in your approach to trading, particularly around position sizing. If you're a longer term trader and looking at swings in your portfolio or swings in your account, this sort of observation becomes critical. When we stand back and look at, and this is gold chart, daily gold chart, when we stand back and look at what a secondary reaction looks like, I've outlined a number of them here. There is, I could have also put one in here, but essentially the statement was they last from 3 weeks to many months, and we can see this particular one here lasted essentially from mid-April out to July as a secondary reaction. Currently in the gold market, we have 2 secondary reactions underway, and it started back in early August and is currently still contained within this lower secondary reaction. This was just taken a couple of days ago when I was preparing the slide. It is still contained within this secondary reaction here now. So here we are from July to essentially mid-November, and gold has remained in a fairly significant secondary reaction. Now, I would point out that these movements inside here are highly tradable, but as an observation of underlying trend, before everyone gets off their seat and says, well, you know, gold's going to $20,000 or $10,000 or whatever, there is not a single shred of evidence in here until we get a breakout and a primary move again away from these secondary consolidations, or a breakdown and we see what we call a primary move. So when we see, I've nominated these with secondary actions, so these areas here where we see the bars standing on top of each other, these are the primary moves, and we can see there's series of them along the way on the chart, and they become what we call our primary move. And primary moves only make up a small portion of most charts, and they're the ones that if we get on too early, they're the ones that we talk about at barbecues. But mostly we see price action really consolidating in here, and at times can be incredibly frustrating for many, many months waiting for a breakout of something to be meaningful. So primary trends are only observed on a weekly chart. So a trend requires an observable trending action. Using the price only, this requires a large time frame. And I want to clarify this statement here using the price only. Number of people will state, well, when a moving average is turned up, it says that the stock is trending. Well, that's actually not true, because we could pull out any moving average that we want and make the price say anything we want it to. For example, we could pull a short-term moving average out and it'll be pointing up, but the long-term moving average will be pointing down, and that's currently the state. In some of the NASDAQ stocks, you've got long-term averages pointing down, but short-term averages pointing up. So we're not interested in averages dictating what a trend is, because it's just simply not true. We're looking at the price only. Is the buyer willing to pay a higher price than what's been paid before? That's the only thing that we're interested in, because it takes a different mindset than a selling mindset to do that. It takes a buying mindset to do that. And if you get enough of them in a row, you end up with a trend. So trends are developed on a trending action, and then a consolidation, and at times a thing called a corrective action. And we'll untangle what all of this looks like as we go today. So when we look at a primary trend, and as I mentioned, it's on a weekly chart only. That's the only place that we really start to look at our charts is in a weekly chart. I would encourage you to stop looking at daily charts and intraday charts trying to figure things out. Stand back, look at the weekly chart, look at where things are really going, look at where the big money flow is, and that shows up on a weekly chart. So what we're looking for is we're looking for a low, and then markets move higher at times, and this retracement, this important retracement here, is underway, and then we see the market has formed, started to rally again before it's met the previous low. So the previous low down here, and we've come in, retraced, but we haven't gone back there where the original buyers were found, and the buyers have come in earlier and started to lift the price again. So this, we need this retracement here to be at least 10%. The average is 33 to 66% of this range, but we need a noticeable retracement and then the advancement again. And as price crosses the original high, the previous high, we then have a higher low in here. Price crosses a previous high. This is the exact point we determine trend. So primary trend is determined here. Now, if you think about this for a moment, this is as black and white as it can get. It either does or it doesn't go past a previous high. There is no debate about it at the end of the day. So hopefully, once we identify this underlying or developing trend, we can see the prices move on and then they retrace as they do. And hopefully that retracement doesn't make it all the way back to the previous lows. And we're looking for this now defined primary trend. We're looking for this to continue. So we start to mark off our higher lows and our higher highs in a broad brush view on these weekly charts. And hopefully markets will continue and the trend is underway. Now, if we're working in a weekly chart, clearly this is a longer term view, but if we're looking in weekly charts to find out where the real direction of prices are, it allows us to come into shorter time frames and identify entry points into that underlying primary trend. When you start trading in the direction of where the primary trend is going, I can assure you that the odds of success are dramatically stacked on your side. And so hopefully this trend will continue, and so far it has. We have this higher low in here, and we have it moving back towards the high. Now, at times we fail to cross that high. We put in a lower high, and we come back and we cross our defined previous low point here. At this exact point is where we define there is a primary downtrend underway. It does not give you any information about how far it's going to go. It could end in the next couple of weeks and simply resume its uptrend. We're not here to make those sort of assumptions, but the hard and fast rule around analyzing trends is where price breaks a previous low, it is then a declared downtrend. If we truly believe we don't know what's going to happen in the future, this will take a lot of pressure off your decision-making process. We just acknowledge what's really happening in the market and act appropriately. So here, in this case, we've seen a new low, a lower low than the previous low, and in this case, a new lower high. So a downtrend is underway, and it was determined back here. When we look at a chart, this is Coca-Cola. There is, I got this out because it has a bit of everything on here, and it's what we have to deal with on essentially a day-to-day, week-to-week basis. We can see I've marked off here on this chart. I kept it quite wide so we could see what was going on. But we saw the highs up here. We saw the lows here, and the last lower low was actually at this level here. So we saw a movement that went straight through the low without any trending action. So we get a movement that goes straight past a previous low. We'll call that movement corrective. We saw that happen in the markets in February this year, and it happens in stocks quite a bit, and can happen in FX in the shorter time frames quite a bit. But we'll now define this movement down here as a corrective move. So then we see the low, the market has trended up and made a lower high in comparison to the previous high. It's retraced, it's made a higher low, and then has advanced again, and this is our point of trend right here. It has advanced again into a new higher high, has retraced, and we can see that these retracement levels are about 30–40% of this advancement level. So we nice little trending action here, and the retracement back into about 30–40% of that reaction. And then again, we saw this immediate corrective move again, where it simply went past a previous low without any sort of trending action on the way, just simply corrected back down there. And then as happens, market made a lower low, so a lower low compared to the previous low. So we describe this as a lower low. And then of course, it set in a corrective action again and took out the previous high. So no trending action, just a simple straight move, went past a previous swing point, or a high point in this case, and set a new higher high, and then retraced back into here, and then moved into a new high. Now, we saw again corrective action, and since then we have this consolidation, higher low, sorry, that should be a lower high in there, lower high, higher low, higher high up there, and then a higher low, and then clearly it has just trended. So the trend was already underway with a higher low, higher high, so it started to trend again inside here, set up a higher low again, and then moved out to these highs out through here. This chart, now that I've drawn all over it, this chart is highly indicative of what really markets are capable of in price action, where we see these swings and trend breaks and that type of thing, and corrective actions, and then the market will simply move on and start to trend again in there. It's what we have to deal with as traders, and that's why I say the trading side of it is something else again from the analysis side. All we can do in the analysis side is say, well, what's the characteristic of this market, or the characteristic of this stock, or the characteristic of this FX contract or gold contract, and look at that and say, well, this is how I need to plan my risk working around this. So the corrective action, as I showed on the previous chart, was this where we may see a trend underway, and we see a straight through sell-off, prices move down past the previous swing point, in this case the higher low, and we describe this as a corrective action. These corrective actions do not change trends, they just simply a corrective action. They're irritating, but they don't change trends. And we're looking then at the following on price action to say, well, it may resume its upward trend, or it may simply begin to trend downwards. So in this particular example I've made up, we have a lower high in here, and it has broken the previous low. So we are now into a new downtrend is declared right here. This is the simple absolute way of declaring trends in markets, and it's done on the weekly chart, must be on the weekly chart. This is where the real money flows in the markets in bigger time frames, and we really want to see where things are going in that time frame. So in this case here, the market has put in a lower high and then a higher low, and a new trend, uptrend, is declared at this point here as it breaks past the previous high. So we have the trending action in place. We have the low, the higher low, and then the higher high. And if you're sitting in front of your screen, instead of screen staring during the day, work through your charts and start to acknowledge where the highs and lows are in these larger time frames, and you'll end up talking to yourself lower high, lower low, higher low, higher high, higher low, higher high, that type of thing, and corrective move. And it is only by that way you'll become familiar with this market that we have to work in. The secondary reaction, as we've discussed a little earlier, is this retracement inside a primary advance. We often see these retracements. They also described as secondary reactions, or simply an advance in the market and then a sideways move, as we can see in the gold chart, into these consolidation areas, these secondary reactions before we're looking for this to break either higher or lower. And these sorts of areas, or back in here, is where we start to get really interested in how price is performing, and we'll be certainly talking about that in the coming weeks. But at the moment, we have a primary trend, secondary reaction, primary move, secondary reaction again, and then a primary move underway. And I'll point that out again here on the gold chart. These consolidation areas are simply secondary reactions. Here is the primary move. Here, a little one here into there, and certainly in the final stage up here. And we could also say there was a small consolidation there. But these very strong movements give you an indication. When we start to look at, we break our chart up into blocks of information about retracements and consolidation areas, can take a lot of pressure off our thinking about what our short-term expectation might be. The gold chart here on the right-hand side, I know it's still within this secondary reaction here. A lot of people got excited when it essentially jumped out of the top out here, but it simply didn't have any. It was simply a corrective action because it went straight past a previous high and then simply failed on there. This is really low probability observations of the market. We want something that's beginning to trend. In here, we saw it come out of this consolidation, consolidate again, and then break out again. This is what we're really looking for as to when we start to look at some form of edge in the market. So weekly uptrend, again, I'll point out, this is just another piece of price action. In here, we have the primary moves, the secondary reactions. I would encourage you to mark up your charts with as much information as you can. If you have a look at my Twitter account, I'll put the charts up there. They're all marked up. I save all my lines and all my notes on my charts, and for future reference, whether they're right or wrong, whether the comments are right or wrong is neither here nor there, but they were right at the time. Consolidation through here, primary move again, up through here for 1 bar, and then consolidation again, and then the breakout, primary move breakout. So the best description of a primary move or an impulsive move is that basically the bars stand atop of each other. We see the daily, weekly bars essentially standing on top of each other. And the secondary movement is simply where the bars overlap each other. So once we start to see bars overlap, we then know that there is a secondary movement underway, which can last from days to weeks, and it can break either way. So it's when, if we took a look at which we'll do at the end of this session, we'll take a look at the Australian XJO, and we are currently in the midst of a primary move higher out of a significant secondary consolidation. This is what everyone's been waiting for. So there it is, the gear marked up. These secondary consolidations, primary move, secondary consolidation, and primary move. So a secondary movement is where the price bars overlap each other. So once we have a primary move underway and when we start to see consolidation, as the bars overlap, this becomes our secondary movement and often develops up into, at times, quite significant consolidation periods from anywhere up to 3 weeks to many months at times. So this area here, when we start to break down our charts a little bit further and we look inside these secondary consolidations, and I would remind you that we're still out here on a weekly chart. So we're looking at this primary uptrend in a weekly chart with primary moves, but lots of consolidation along the way, and then ultimately the primary move out of the top again out through here. And currently we have a consolidation secondary market underway at the right hand side. But these secondary markets here in the larger time frames, in the big time frames, the weekly charts and the monthly charts, start to get a little bit interesting when we bring in a different time frame. And this is where many traders, from my observation, many traders become wrong-footed in the market. We often see these retracements, what we see is a primary uptrend with a series of higher highs and higher lows on a weekly chart. When we look inside these secondary retracements, and this took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 weeks of decline in this price action. If we look at a shorter time frame, in this case a daily chart, it will often look like a daily downtrend. Lower highs, lower lows, lower highs, and then we get higher low in this case. A lot of traders will look at this and go, this is trending down, where all that's happening is it's simply retracing as part of a much larger primary uptrend. This is low probability trading. Looking at this type of thing, I often say in the workshops that I do and that type of thing, that it's okay to trade against the trend. Just say to yourself, I'm trading against the primary trend. This is a low probability outcome, and I might be better to wait until the trend resumes, and probability will become stacked on your side again as markets advance again. So that's one of the key aspects I find in observation of traders, is that most traders spend their time on intraday and daily charts without any real clarity about where things are going in the weekly chart, in the larger time frames. So an example here, this is the gold chart again. We can see on the right hand side we have a series of higher lows and higher highs. We had a bit of a corrective move there, and then a very strong corrective move out to the high recently in August of 2075 up there. So the weekly trend is actually up, and currently we have, as we discussed earlier, we have these two fairly significant secondary markets underway in the gold chart. But when we look over here, this area over here in the daily chart, we go, well, this is actually trending down. But we're actually simply in a consolidation out here in the weekly chart, and we'd be looking for at least the primary trend to resume, because we have no evidence just at the moment of trend reversal. So until we see that this chart here is trending up, it is in a fairly significant secondary market at the moment, and there is no evidence to suggest it's going to break into a downtrend until it does. And what it really needs to do is start to put in a lower high, and this may have been the lower high here, and then start to break into new lows, and then we'll declare there is a downtrend in gold. But the daily chart doesn't give you the primary trend. The weekly chart gives you the primary trend. The daily chart is interesting, can give you some short-term plays, but the weekly chart is really where direction is found in the markets. And we come down into, just as an example here, we come into a smaller time frames, a 5-minute chart against a 1-hour chart. We can see, and this is in the S&P 500, in this 5-minute chart, we have everything that sets up a change of trend. We have the highs and the lows, and the lower highs and the lower lows, and the lower highs and the lower lows, and lower highs and the lower lows. Then we had a corrective move. We put in a higher low in here in this 5-minute chart. Then it broke out here and started to trend on a 5-minute basis. Now the problem with that is over here on the hourly chart, this bar at the right hand side was simply one up bar as a retracement. The market's already put in a lower high, and we're now potentially looking at either resumption of the trend or just simply a retracement of some type before it breaks lower. So we're looking at smaller time frames without any real information in the larger time frame. And what happened with that was we broke out and immediately broke down again we can see that the hourly bar, simply retraced and then broke down again and started to trend down on an hourly basis. So we can apply, let me break this up a little bit. If we're looking at what we call primary markets, we're looking at large time frames. If you choose to work down inside smaller time frames, at least acknowledge where the large time frame is, but we can still make this same application of trending action is when highs and lows are broken in our price action. So part of this now is when we start to draw trend lines around our charts. And over the years, I think I've sort of developed myself into a bit of a monitor on this. So I get quite irritated when I see some of the work that goes up, particularly on some of the social media sites about what people define as trend lines. And I really want to encourage you to apply some discipline to your line drawing on your charts. So in trend lines, there is a correct application for trend lines. There is a correct application for trend lines. Trend lines are not drawn as the best fit, which is convenient in a lot of cases, but they're simply not drawn because they happen to fit there. And trend lines are not artwork. So what looks right is not necessarily right on our chart. There's a very, very simple concept around trend lines. A trend line, when we start to look at drawing trend lines in our chart, trend lines start from the lowest low that you can find. And you may need to go back months or years to find that low, but essentially that's where trend lines can start from, is the lowest low that you can find. If you're in a downtrend market, then trend lines start from a highest high that you can find. Not the most recent one, but the highest high that you can find in the background. The most important concept about a trend line is they never cut back or cut through price action, and they never cut back through price action. They never do any of those, one of those two things. Now, there's a reason for that. Is if we start drawing trend lines willy-nilly on our charts, everyone will have a different interpretation of where it should be. But there is a defined method of drawing trend lines on charts, and we'll go through what that is. So as I say, if we find the lowest low in the market starts to trend, puts in a high, retraces, puts in a higher low, and then breaks through that high. So okay, so we have a trend underway. We draw a line, then we can only from here, once we observe this, only then can we start to draw a line, and it's drawn from the lowest low to the next low after the previous high. Trend lines connect the next low, the higher low, following a high. So following this high, we see a retracement, market starts to advance, we can start to draw our trend line. But it's not a confirmed trend line, it's simply tentative at this stage. Trend lines never cut back through price action ever. So if we were to extend this line backwards, it would not interfere with any further price action in the background. Now this kind of cuts out a lot of stuff on your chart when you break it down to this. And basically it means that there may be only one or two actual trend lines on your chart if they're important to you. So once we see the market advance and we see a third touch, new high, higher high, market continues its trend. These are our trending points. We have 1, 2, 3, confirmed. Now we have a confirmed trend line. And again, I mentioned to you that trend lines never cut back through price action and never go through forward price action as well. This type of thing is not a trend line. I notice people inherently draw what they think is right, but the fact of the matter is that the line started from the low here, went to the next low. It was broken at this stage, so it just proves that this is not the trend line. Even though the market did advance again, and we simply have to move the line down to this low and begin our tentative count again. So we have 1 and 2 on there. Drawing trend lines, if you start drawing trend lines that cut through price action, I can assure you, you're really wasting your time on this. There is a, if I was to draw up mark up a chart with my trend lines and someone in, as I say, one of my colleagues in either Chicago or London or something was to draw up the same chart, we would both have the same lines on there. It is a fixed observation. It can't be disputed. If this is the low, this is the low, those 2 points cannot be disputed. So this is where the line tends to. So here's an example of ANZ, pretty current chart. So this was the highest high out here in 2015. We saw the market trend down. This is a weekly chart, I would point out. We saw the market start to trend down, so we had a line come down through this price action that was broken here. So that's not it. That's not the trend line, and it would have again been applied down through here and broken again and so on. And then we saw the higher low, lower high, but then a higher low again, broke into an uptrend just here and started to trend again. So if we start drawing our lines through here, we just make sure that this doesn't cut back through any price action on there, otherwise it's simply not a trend line. As this developed up and ANZ broke into a downtrend again, we can see that the trend line accelerated down. We extend this backwards, it doesn't cut back through any price action, and then went into this lower high in here. It's quite interesting. At times you hear people complain about these stocks that lose price very, very quickly. They gap down and they go down for a couple of days at a time. And I look at these things and then I go and look at the weekly chart and go, okay, well, you've already had a lower high in the background and it's been trending down. This is only part of the downtrend. This is nothing unusual. So then currently ANZ has started to trend up. It's put in a higher low in here. It's put in, sorry, the high here. I'll just move this here, the low, take that out of there. The high up here, the higher low recently, and this week it started to trend again. Now inside there, these are not trend lines down inside here. The line off the bottom would simply now be moved out to this area here and begin out a new trend line out there, no matter how far the price is away from it. But we've now got ANZ starting in a primary uptrend again. No information in here to say it's ever going to continue back to its original highs or anything like that. All we know at the moment is it's in a primary uptrend. So these internal lines in here, if they cut back through price action, are simply not trend lines. So the same applies when we look at support and resistance. When we define support and resistance in our chart, I've mentioned the word spike high here. I'll go into the details around this next week. But support and resistance is defined once we think we have a secondary consolidation underway. And so the first rule is we start from the last high if the market's been moving up. And the second one is we start from the retracement low. So as the market moves up and then goes into some form of consolidation, we take the next low as our support level and we take the high as our resistance level. Those 2 points define our secondary consolidation support resistance. Now, the market may not come in to test that support. It may come through that support, but this line, this was our original point where the buyers were found. This is our original point where the sellers were found in this particular market. This type of thing, in here we saw the low, we saw the higher low. In there, markets moving into consolidation. Even though it's broken through there, we tend to ignore that along the way. So this is what it looks like on a chart. Initially, this price action came down, formed a low, formed a high, started to consolidate a little bit. So our support level went through here, our resistance level went through here. Market broke to the lower side, broke through support, made a new low down here. This is where the buyers were found again. And here the market rallied. This is where the sellers were found again, and then it entered into this consolidation. So this becomes your support level. This becomes your resistance level. So we can see in future price action whether that level is respected or rejected as markets unfold in future price action. So we're looking for the significant low and then the next retracement high, the significant low and then the next retracement high to determine where our support and resistance lines go, and they are not moved going forward. It's interesting that the price went through there. That's the observation, but this was the first place that the sellers were found, and in this case they were found there again. They were found there again, and here they are. They've rejected that general area again. So we can see that the support was never really retested, but it could easily be retested at some point in the future down here. So support and resistance is determined from the last low to the retracement high. Oops, and there we go. So there we go. So a lot of information in 50 minutes. I'll take some questions. Evan, if there's any questions to go, and we'll try and get through some questions. And I'll go back, if you like, over anything we need to, and otherwise I'll pull a couple of charts out and we'll have a bit of a look. Come in, Evan. All right, we'll go and take a look at some charts. Okay, so all right, Evan. Okay. Question here, is there any position in portfolios for gold stocks like Newcrest and Northern Star in this rising market? That's a fairly broad statement. Let's take a look at that. Let's get out of this. All right. Bear with me just a minute. I just want to get this other. Here we go. So I've got Iris here. I've talked about this trending action inside Iris and inside MT4. There's a very nifty little thing called a zigzag tool in here. So a zigzag tool, it's under your indicators. It's just simply called a zigzag tool. If we look inside it here, you can set your deviation. Now I've said 10% in the notes. You can set it, I've got it set here at 10%. The depth is, I asked Iris what this was about. It relates to some look back period in there. So I just use the same number, 10 on there, seems to work okay. And what it does is I've got it set at magenta, and it simply draws in the significant trending points out here. Now this is a daily chart on ANZ. Let's put it into a weekly chart. And here we can see, we talked about this a bit earlier, that, let me get this out of here. There we go. So down in here, we have the low, the higher low, and ANZ has gone in to make a new high. So clearly the trend has changed this week here. This is now a weekly, whoops, this is now a weekly chart. So ANZ is now entered into a primary uptrend, and this was the secondary reaction. So as I mentioned, this was the original trend line on there. Let's grab that trend line. We now move it down underneath here. So we have correct application on that. But we're looking at, the question was around Newcrest. So was there any space in, if we don't bring our baggage to the table about what we would like to happen or what we think is going to happen or what could possibly happen, and we just look at the way things are, then we can see Newcrest over since, I'll go back to 2017, we can see this very mixed trending action. This is still set on 10% swings, 10% or more swings. So we can see this very mixed consolidation, short trending action in here. Then it trended down, broke into a downtrend, and then went into a significant corrective move up through here. It then retraced. I mentioned earlier that these retracements can be anywhere between 33 and 66% of the primary move. What that means is the, come on, this one. This is the primary move, this part. That's the primary move. And so when we start to see these retracements, it's really worth your while to understand that this retracement can really wind up as a 33 to 66% of this advancement as part of your risk. We then saw a higher low. This is good. Market rallied again, and we can see again, that this retracement here, in this particular case, retraced about 30% of this downward movement. Now, I'm with you in the fact that we don't know, we would like it to advance, but and we'll go into this in some detail next week about reversals, that type of thing, but this simply retraced 30% of this upward movement and then lost it and started its downward movement. So Newcrest entered into a primary downtrend, at that point. We have a high, low, lower high, lower low. Newcrest has simply then put in another corrective move out through here. And we have this current retracement that could be anywhere between 33 and 66% of this advancement up through here. There's nothing unusual in this chart per se. So we have Newcrest defined a downtrend, a corrective move in through here. We have no evidence of trend change, even though it has rallied up through here. Corrective moves do not change trends. They're irritating if you're on the wrong side of them, but they simply do not change trends. And currently, as you can see, Newcrest is working its way down here. Whether it belongs in a portfolio or not, I don't know. All I know is it put in a high up here. After a corrective move, it was a lower high than the previous high back here in August, and now it is moving down. We saw drawing tool, sorry. We saw a secondary market here. And our support level, this was the last low. So bear with me. Iris is not my first charting thing, so just bear with me a second. This was our resistance level. Now we saw the market move down. This is a weekly chart. We saw the market move down, make a low. This is where the buyers were found. We saw it move up, and then we saw it reject. So this bar is now overlapping this bar. We are now in a secondary environment. This can last for days, weeks, or months. And so our first resistance level is this retracement high here. This is our initial support level down through here. And we can see currently it's broken through that support level and has entered into another secondary market for 3 weeks. This area here. In fact, that's the support level, and that's the new resistance level, the high just in there, and it's broken the secondary market support level. hopefully in this presentation tonight, my intention was to give you some hard and fast rules around analysis of your charts. Sometimes it's uncomfortable, but there is a severe reality when you start to apply your rules or the rules of analysis in a disciplined way. It can help you make some decisions and observations around prices and potential outcomes of prices. So currently, we saw this week Newcrest has just broken to that low. So this retracement here, it's about 50% of this range. It could be 66% on average. It could be more. It really depends where the next move comes from in the stock. So in answer to your question, I don't actually know whether it should be in your portfolio or not. If we take a look at Newcrest, we can apply this, Northern Star. Northern Star, I don't know why Iris doesn't draw that last line on there. There's something that they can take up with TradingView. But we can see in Northern Star, very different picture in Northern Star. We have the low, the high, the lower low from the previous low, the lower high, really nothing going on. Again, consolidation through there. Then the higher low, and then the breakout. So we saw the initial breakout here off that high. This is our trending point. Right there is our trending point as the market's moved out through there. We see that the bars are standing on top of each other, so it was a primary move, and then we saw this corrective move, and then a primary move again into this new high. The market then again pulled back, so our support level is drawn here. Support level is here, and our resistance levels, there's the low, there's the high. This bar here is the high. The second bar in is the high, so we can draw. Come on, let's go. We can draw our resistance level off that high there. This is called the spike high, and this is the previous one back here is a spike low. So this becomes our intimate resistance level and our intimate support level as, oh, sorry, I've got an XDC up here, but this will do, as this consolidated and then broke through and so on. Let me go back, I'll correct myself. Northern is in ST, not in XT. There we go, sorry. Okay, so we can see in Northern Star, I should say, it has a series of lows, highs. This is a higher low than this one, just a higher low. Went in to make a new high, currently has a higher low in here, and recently made a new higher high up here. So we can see even in these 2 weeks here, this retracement of this advancement is underway. I would, in this particular case, whether this is the beginning of a primary move, because we have a very strong bar here, a very strong bar here, and a very strong bar here. We saw a failure of a very strong bar on the upside and then simply failure to the downside. It doesn't mean anything until we start to observe some noticeable break, and it's either the break of that low in here, as we have a higher high, it'll end up as a corrective move. This is, I opened up my presentation with this, is we're not trying to predict what might happen in the future. We just really want to put into context what we have at the moment. And so our low down here, we have a higher high up through here, and currently we have a retracement. The question there about how do we determine the spike high and spike low, I'm going to go into that in significant detail next week, and it's not a lot of detail and it's very simple. but I'm going to go into that next week about looking at this short-term price action on our charts. The key about whether something should or shouldn't be in there, I would just encourage you to do the work. Just do the work on your chart. Apply the concepts that we've looked at tonight. You'll find them in every textbook, every good textbook on technical analysis. Apply those concepts to your charts rigorously, and then stand back, as they say, hop out of your chair and stand behind your chair and have a real good look at how things are going. And it'll give you a significant insight into your potential risk and potential reward in there. So the later question, where would you buy into an uptrend on Newcrest? Newcrest has, I'll go back to Newcrest. Newcrest has a lot of work to do. Newcrest needs to, before it starts to trend, and if we look at the probabilities around trend, then once things start to trend, we basically stack probability on our side dramatically. This needs to form a higher low in here and break this high. It needs to break this, what is that, $38 high out through there. Break that on a primary move and you've got a trend. You've also got probability stacked on your side without trying to guess where the bottom is. But at the moment, you're in a significant retracement and it's breaking the secondary market, these consolidation areas, is breaking the support levels on there. I mean, you know, I'm getting a bit off. No, I won't go there. But people can write all they like about it. But the fact of the matter is that the sellers have got hold of this and they've broken a support level. That's the observation so far this week. All right, so the spike highs and spike lows, as I said, I will talk about those in detail next week. What we're going to do next week, this is where we left off. So next week, we're going to start to look at setups inside these trending actions. So how to identify setups and the probabilities around those setups. We're going to take a look at price action bar by bar. We'll look at the spike highs and how to determine a spike high and spike low. It's very, very simple. And we'll look at some very simple patterns, price patterns, ABC type retracements. And then we'll define what an actual pivot point is and a 3-bar reversal, and look at the some of the observations around outside bars and inside bars. So another big week next week when we start to build on this underlying trend. So none of this shorter term price action is ever going to work for you unless we take on board the underlying primary trends and support and resistance levels of an individual market. When you look at primary trends in markets, you'll see that if you're looking at the gold market, it'll look different from, say, a wheat market or another type of market, equities market, a stock of that type of thing. They all have their own idiosyncrasies, and it will do you well to study the market that you're interested in some detail. But first of all, look at the weekly chart, stand back, start to observe where the big highs and the big lows are, start to join them together and see whether the buyers are willing to take it into a new high or the sellers have taken it into a new low, and that's the information that you need to make some informed decision. All right, Evan, I'll leave it there. We've gone a little bit over time. I'll leave it there. If you have any other questions, I think we can go here. Certainly they'll pass them on to me. They'll pass them on to me during the week, and we can get back to you. And if you've got any specific questions around things or missed something, I'll do a quick review of this week next week, and hopefully see you then. Thank you.